I know we've got a lot of focus this week on those bond auctions in the US. Some people on TV today have been saying that this term premium is really showing that although the markets have started to price in what the Fed is doing, they're not pricing in the supply-demand issue as much. Is that how you read this chart?
To an extent, yes. I mean, I think the factors that would tend to cause the term premium to rise, I think additional supply, and particularly at a time when maybe the Fed are also contributing to supply from dialing back QE, and also potentially somewhat higher market volatility. So we think term premia are likely to rise, even if the Fed is tending to flatten the curve by potentially raising rates more than the market has been expecting.
And when you say term premia are likely to rise, you mean to go into positive territory? And if yes, does that pose a risk to equities?
I think they can go a bit further. I mean, I think they are, as you said, suppressed to some extent by a lot of the factors that have been holding down yields for the last few years. So interest rates are not going to go up that far. Volatility, I think, is something that we haven't yet seen much of, but I think we expect to see more of in Treasuries. Is it a risk to equities? Equity markets typically can still rise in a rising rate environment. I think it depends on the extent. So if we see a very sharp move, then it's more problematic.
This move at the front end, John, the 3-month bills yielding 1.63%, up 6 basis points, or up 3.5 basis points for the 6-month bills. Is that a major move? Anything to be concerned about?
Well, I think there is bound to be some pressure on very short-term rates, partly because clearly the Fed are in the process of raising interest rates. But in particular, the US has chosen to focus a lot of its supply in bills and short-dated bonds. So, that requires some, I think, give up for the market to absorb it. There's a lot of paper coming, and so it's not surprising if bill yields are rising to some extent.